Hi everyone, in this video I'll be showing you my Ultimate S&P 500 strategy. So in this video, first I'll be showing you how to determine your daily bias, how to know if you're trading to the upside or trading to the downside. Second is the time and price. So we're showing you the exact time where you'll be expecting price to form a specific pattern for you to execute your trade. Why? 3 is the entry model. 3 is what you will be waiting for you to execute your trade. So the particular pattern, what you need to see price to do before executing your trade. So let's dive to the charts. Before we get started, you know that Forex Trading Empire have a free Telegram channel where we discuss, a free Telegram group to educate you. So if you want to have access to talk to me personally, to ask me questions and have access to our course, it's absolutely free. You join the Telegram channel, which link will be linked in the description below. So before we go, we'll be going down into Friday price action. So we'll be talking about what price created on Friday. So on Friday, before the Friday price action, this is the Friday open of London section. So we'll be adding the time indicator. So in this video, we'll not be using a replay. We'll be looking price strictly on what I was looking for before price did the price action. So on Friday, before the opening of the New York section, I was paying attention on taking price to the upside because when looking at the chart, you can see that price is in an uptrend where price is creating swing low, swing high, swing low, swing high, swing low, and a swing high. So during the London section, price have been trading to the upside, creating a consistent 1 hour candles to the upside because this is the 1 hour chart. So I was merely paying attention on price to continue the up move at New York Q zone. So first, what you have already determined your directional bias. All you'll be paying attention is what will drive price to continue that daily directional bias. So that was when I was stacking it into other blocks, fair value gaps. Zoomed in into that day's price action. So looking at this time frame, all we're looking for was looking for something that can drive price to continue its trend. What will drive price down to continue its trend, so that when it gets to the New York Q zone, that is where we execute the trade. So we're just looking for what price would drive into. That is painting your point at liquidity points, fair value gaps, and point of interest where price might pull back to. So for those that don't know, the meaning of fair value gap is when you see a candle, it mostly formed by 3 candles. So when you see 3 candles and you see a gap between the first candle to the third candle in wicks. So the gaps in wicks, you can see that this candlestick stopped here and the other candlestick stopped here. So the gap between this candlestick wick to this candlestick wick is known as a fair value gap. So the fair value gap and the point of interest, that's the areas you'll be expecting price to pick its momentum form to continue the trend. So looking at this, you can see that as New York section open, price pulled back with a 2 candle close straightly into this fair value gap, and after it tapped into the fair value gap, you can see the price drived to the upside. But in case you did not see any fair value gap before 9:30, because 9:30 is the London Q zone where stock market opens, so that is where we mostly execute our trade. Most of our trade setup mostly forms after 9:30. So before 9:30 and you do not see any fair value gap, to wait for price to pull into the fair value gap, you go to lower time frame to look for swing points. Swing point that will be used for liquidity to push price to your intended direction. Since you're waiting for price to push to the upside, we'll be looking for we'll be looking for buy side liquidity on lower time frame that price will sweep, so that after the sweep of the buy side liquidity, we'll be expecting price to push to the upside. So let's go to the 15 minutes. So we are on the 15 minutes. And looking at this 15 minutes, you can see that this is the same fair value gap, and you can see that even on this time frame, the fair value gap is clear for you to see that this is a well respected fair value gap, and you can see that as soon as price pushed in into this fair value gap, it started creating higher highs to push to the upside, continuing its intended trend. So looking at all these swing lows and swing highs, so all these are liquidity points that you should have marked out prior to the open of 9:30, that is New York stock market opening. So marking out all these liquidity points, you wait for each of these liquidity points to be taken out. So if price sweep this liquidity, it should be after price sweep the liquidity, you need to wait for the 9:30 to push into all these liquidity pools, taking out all these liquidity pools before you start looking for an entry after 9:30 New York stock open time. So you can see that. So this is 9:30. This is 9:30. This candle here is 9:30. So this is the 15-minute time frame. So this candle is the 9:30 candle. So 9:30 candle, you can see that before the 9:30 candle, price came for this liquidity, this buy side liquidity, came for this buy side liquidity, drove down, taking out all traders holding up their trade, trailing their stop, taking them out, all of them, before pushing to the upside. As soon as 9:30 reached, you can see that price dived in into this fair value gap, the 1 hour fair value gap, and there it picks its momentum and start trading to the upside. So this is seeing price clearing out all this buy side liquidity, buy side liquidity, buy side liquidity. This is telling you that price, most often after price taking out all these liquidity points at the prior to 9:30, you see price reverse to the upside. So now most of you might be asking, like, how can I execute my trade from this idea? So once you see that price have already taken out all these liquidity points and maybe pulled in into a higher time frame fair value gap or a higher time frame point of interest, it doesn't matter if it pulls into a fair value gap or higher time frame fair value gap. All you need to see that you know where you are trading to, and you need to see price sweep the opposite side liquidity prior to 9:30. Then you wait for price to reverse. You go to lower time frame, wait for price to reverse to execute your trade. So executing this trade was executed on the 1 minute time frame. So let's go to the 1 minute time frame and show you how you can execute this trade. So we are on the 1 minute time frame. Looking at this 1 minute time frame, you can see that as soon as after 9:30 New York stock open, you see the price dives to the upside. So seeing price creating this move, let me shift this out of the way because this is the fair value gap. As soon as price got into this fair value gap, you can see the picked up momentum to the upside. As price pushed to the upside, this is telling you that price has already shifted structure. You can already call it a shifted structure or a displacement. So you can see that price displaced to the upside, and you can see that after taking out all this liquidity, all this buy side liquidity from the 15-minute time frame, you can see that price already took out all this liquidity before doing this displacement. So seeing the price have displaced after taking this buy side liquidity prior to 9:30 New York stock opened, so you have to pay attention to the time. So that's why paying attention to the time is to tell you that seeing the price have already swept out liquidity prior to the 9:30 is giving you a clear indication that price might reverse the trend and move to your intended direction of the day. So getting your directional bias is to tell you that you're expecting price to sweep that opposite side liquidity to continue its trend. So on the 1 minute, after price took out those liquidity, tapped it into the fair value gap, you can see the displacement here, where price displaced to the upside. After price displaced to the upside, broke structure here, giving you a clear break of structure. This is to tell you that price is now ready to push to the upside. So this is the break of structure. So you can see that after the break of structure, all you'll be looking for is either you look for a fair value gap or you look for an order block. So in this trade, I was merely paying attention to the fair value gap. So I placed my trade at the close of the candle that opened, that created the fair value gap. So this was the area I was paying attention to, because if you look closely, you can see that this is the extreme fair value gap. So my trade was executed at this extreme fair value gap. So if you're executing your trade, you pay attention to the fair value gap, because most often price pull back into the fair value gap of your entry time frame. So you can see the price pull back to the entry time frame fair value gap, giving you a clear entry. So you can set your stop to the swing low of the swing points. So you set it at the swing low of the swing point, then your target. So about the targets, there are two ways you can target, but the most assured targets for you to go for, where most likely price will go for, is the sell stop liquidity. So the sell stop liquidity at the 15-minute time frame or the 1 hour time frame, that's the liquidity you go for. Back to the 15 minutes. What you target is the sell side liquidity. So this is the sell side liquidity because sellers try to take price to the downside, taking a sell, stop losses placed above this area. This would be a clear liquidity pool where price might come from, and other traders will be seeing that area as an order block, which is not an order block. So this is trying to tell you that there will be lots of sellers here. So this will be your primary target. So you'll be dragging price, you'll be riding price straightly to the sell side liquidity. Because remember, you're getting into the market from the buy side liquidity after the sweep of the buy side liquidity. So you knowing that if you're looking for a target, you'll be looking for a swing point to target. And which swing point is well shown that sellers will be well interested of taking a sell from that area. It should be this sell side liquidity. So you can see that after we got into the market in the 1 minute time frame, you can see the price traded straightly into that that sell side liquidity. So when using this model, when using this concept, you need to pay attention to the opening of the New York stock market. You need to see price take out liquidity, not, let me just say, a low momentum sweep of liquidity. You need to see a high momentum sweep of liquidity, because pay attention to this side. As soon as price got into New York section, you can see that price was driving down with a high momentum with no opposite side candle. It came straightly down, which each candle did not even trade above the other candle, straightly down, taking out all this liquidity. Seeing this power taking out all this liquidity point, diving deep into a higher time frame fair value gap, this is giving you a clear indication that if price were to reverse, it will have enough power to move to the sell side liquidity. So whenever picking out this, using this concept, you need to pay attention to prior to the 9:30 New York stock market opening. So I'm using New York time to determine the time, but if you're a Nigerian, that should be around 3:30, because the New York stock market opened 3:30 to Nigerian time. So you pay attention to the opening of that time. wait for price to sweep out the liquidity. You need to wait for price to sweep out New York, need to sweep out London liquidity or Asian section liquidity. So the green maroon area is the London section liquidity. Sorry, the London section time, and you can see the red side is the New York section. So the maroon area is where I primarily trade on. I trade from 9 to the close of the London section. So all you need to do is to pay attention to, as long as you're already on your directional bias. So you pay attention to the opening of the 9:30, where you are expecting price to dive deep into swing point, buy side liquidity, or if it was a downtrend, you wait for price to trade into sell side liquidity. So price trading into sell side liquidity, that is where you go into your lower time frame, waiting for price to do a shift of structure. And after this shift of structure, that is where you execute your trade. So going back to the 1 minute, after those sweep of those liquidity, all you're waiting for is a price to shift on your entry time frame. So if you're using the 15, if price is taking out the 15 minutes liquidity, you should be going down to 2 minutes, 1 minute, or even the 5 minutes. All you're waiting for is you need to see the shift of structure showing that price is trading to the sell side liquidity. So this whole model is mainly based on taking both side liquidity. But first, you need to wait for one side liquidity to be taken out to give you a clear indication that price is going for the other side liquidity. So price, in this example, price already took out the buy side liquidity. So after taking out the buy side liquidity, that is where price displaced to the upside, giving you a clear entry. And this should have been your entry point where you should have executed your trade and traded it to the upside. I think this trade was a 1 to 6 hour. So if you're interested to see more examples on these concepts, make sure you like and subscribe to the YouTube channel to get notified, and on your notificational bell to get notified when I drop a new one. So see you in the next video.